Hello, good morning, everybody. This is Joe Lucey. Um, just wanted to welcome you to this week's Market Huddle. I had an interesting conversation on our radio show last week, and we had the guest, longtime mentor of mine. His name is Ed Slott. He's considered America's #1 IRA expert. That's not from me, that's from the Wall Street Journal. And, we were talking about his brand new book. This is a book that was released here on March 2nd. And, this follows up the book. It's the new Retirement Savings Time Bomb, follows up with his previous book, which was the IRA Time Bomb, Retirement Savings Time Bomb, which was published initially over 20 years ago. It's a #1 bestseller on the New York Times and what have you. It's actually the book that got me involved with him and his organization way back in the day. Ed Slott, if you aren't familiar with him, he's a CPA out of upstate New York. He, as I said, he wrote the Retirement Savings Time Bomb book, and now he's come out with the new Retirement Savings Time Bomb. And if you're an existing client of ours and joining us here on today's Market Huddle, I want to make sure everybody gets a free copy of this. So I'm going to talk about that in a little bit. But if you are not an existing client of ours, this is really a great book to read. I think that it talks a lot about those things that we may not know about our retirement planning, reasons to make sure that you're working with professionals that help retirees retire every single day, like we do here at Secured Retirement Financial, and making sure that we're looking around corners, making sure we're looking at those things that you may or may not already be aware of with your retirement accounts. So today, what I want to do is I want to talk about the 4 options. These are the only 4 options that we could come up with. Ed talks about it in his book, by the way, on what to do with the biggest check of your life. What is the biggest check of your life, you might be asking? Well, for many of us, it is that 401k balance when we retire. What are the options? What should we be considering before we make our decision to roll our 401k or to keep it place, or do we convert it? Are there other options? We're going to talk about it real quick, and then if you're an existing client, we're going to make sure that everybody gets an opportunity to receive a free copy that's joining us here on today's Market Huddle. If you're not an existing client, well, good news. We're going to make sure that we get you an opportunity as well for the first 20 people, because we record this. We also send it off afterwards. First 20 clients that are not existing clients of ours that would like a copy of this book, all you need to do is schedule a strategy call, a complimentary review of your existing situation. Maybe you were in a couple years ago. We'll find an opportunity to kind of re-engage, figure out where you're at. And following that, we're going to make sure you get a signed copy of Ed Slott's book too. So I've got one here. It's probably got your name on it. So anyways, let me go through the 4 things that me and talked about last week on our radio program. In fact, I'm supposed to post this. Let's see how this works. In the chat box, maybe this isn't going to work. I am trying to post. There it is. In the chat box is a link to our radio show from the weekend. This is the radio show that we aired between 9 and 10 on Saturday. In that is a great interview that we had with Ed Slott. So bonus material outside of today's Market Huddle. Go to the iHeart website, download that, listen to it at your convenience, and what have you. Let's move on. Very first thing that we can do with our 401k, the largest check that you may ever have when you retire, what do we do with it? There's 4 options. The first thing that you can do with it is, well, do nothing. Just leave it where it is. Now, rarely in my 27-year experience have we found that leaving the account in place is the best option for most families. But there are reasons why you might want to consider this. Biggest one that comes to mind here is if you're retiring prior to 59 and a half, or you're leaving employment, you may be in today's environment looking for another role still, but you're over 55 when you leave your employer. You can actually withdraw money from a 401k, a 403b, a thrift savings plan, these employer-sponsored plans. I can roll that, I can keep that money there, and I have access to it without a 10% withdrawal. Now, If you're over 59 and a half, this doesn't work as it's not as important to you. But if you're between the age of 55 and 59 and a half, if you were to take that and just automatically roll it into an IRA, while there's a lot of reasons, and I'll talk about that in a second, why this might make sense. If you did just roll it into an IRA and you're over 55 but under age 59 and a half, you're going to be subject to a 10% penalty for the withdrawals. Now, there's other ways around it. We can take systematic equal periodic payments called a 72T, but that really starts to paint us into a loss of options. A lot of retirement planning is about making sure that we keep our options open to us, make sure our retirement planning is fluid and can be adjusted. So for those of you that might be over 55, considering leaving employment, or maybe it's not even considering, maybe it was involuntary on your behalf, but you're in the middle of a transition, whether it's into retirement or into your next success. If you're over 55, if you leave the money in place there, you'll have access to it without a 10% withdrawal. The biggest mistake we see around this is families or Americans, we just think that we're supposed to roll it as soon as possible. We roll it to another advisor. The other advisor may not be aware of this, and all of a sudden you put it into an IRA, and once we do that, well, now we're going to be locked into a 10% penalty for withdrawals without some other planning, and that can be problematic. Best thing, if you're between 55 and 59 and you aren't sure what you're doing, schedule a time with somebody that goes through this. That's one of the reasons I've been a member of Ed Slott's group. I've been doing this now for over 13 years, and I do this because the continued education it gives, and this isn't just online classes. I'm talking about over 40 hours of continuing education, be part of his group so that we are up to date on IRAs, the do's and don'ts, and what have you. And that's what we're really talking about here today's Market Huddle. What are the do's and don'ts that we should be considering as we look at moving our largest check, which for many families is that 401k that they can roll over when they retire. What's another option? Well, you can just leave it there, obviously, but the second one is you can roll it. Now, this is probably for most families maybe the best thing to start to consider. Once you roll the money from a 401k or thrift savings plan or 403b from the company plan that you were working for into an IRA, generalizing somewhat here, but you're going to have a broader options when it comes to investments. In fact, we can start to look at other investments outside of your typical stocks, bonds, and mutual funds, but even in most 401ks or thrift savings plans is a great example where there's only 9 investment options. Rolling money into an IRA, now all of a sudden we can pretty much really expand what we can invest in. Not only that, it's going to give us more flexibility when it comes to things like maybe getting the money into a tax-free status. I'm going to get to that in just a second. That's one of the other 4 items we have here. But rolling it makes a lot of sense. The thing is, let's make sure before we roll it that we look at all the other areas, other options as well. Don't just automatically think that rolling the 401k into an IRA is the best option for you. Some of these other options might make some sense too, such as the next one. The third option we can do, take a lump sum. Now, taking a lump sum isn't just taking the money out and paying tax on it and living on it. Some of us work for a company whose 401ks will make contributions of company stock. I'm thinking off the top of my head of some that we've seen in the office here recently. Families that have worked for Delta Airlines, families that have worked for Honeywell, families that have worked for 3M, pretty much most of your Fortune 500 companies. Ingersoll Rand is another one. These families that have worked for these companies, a lot of times the company will make a match into your 401k. When they make a match into the 401k, when you retire, you have a once-in-a-lifetime opportunity to potentially take the stock out of the 401k and you can put it into a regular brokerage account. Well, when you do that, what will happen is the cost that you paid for that stock. So you only want to do this for companies whose stock have increased in value. We had a client recently. Their cost on their stock in Honeywell was 20% of what the value of the company stock was. A better example, in this situation, they had about like $500,000 worth of company Honeywell stock. Their cost on that was $100,000. When they take the company stock out of the plan and put it into a brokerage account, it's not even going into an IRA, it's going into a brokerage account, they're going to be taxed on $100,000 of income. You say, well, why would somebody be taxed on $100,000 of income? Why would they choose to do that? Well, once they do that, any of the additional $400,000 is taxed at only capital gains rates. Now, depending on where your income threshold falls in place, that capital gains rate can be anywhere from 0% to what many families are paying 15, 18.8, or 23.8. Those are the three capital gains rates once we look at the net, some of the other income taxes that fall in place. So paying by doing this, you can oftentimes pay a lower amount. The best other advantage of it is that you are not going to be required to take required distributions. We talk about that a lot here on the Market Huddle. We talk a lot in the radio program about it. Required minimum distributions a lot of times will have families forced to take money out of their retirement accounts, and it may be money that they otherwise wouldn't regularly need to live on. When that occurs, in this example, we had $500,000. 4% of $500,000 is $20,000 a year. That's a required minimum distribution. I'm generalizing a little bit just for the sake of not getting into the weeds here too much. But if I had to take $20,000 out and I've already got all the income I need, I'm being forced to take money out of an IRA and pay tax on that money at a time when we know tax rates could be much higher. By repositioning it, taking advantage of what's called net unrealized appreciation, it makes a lot of sense. So anybody listening to today's Market Huddle, we got quite a few of you here today. Anybody listening to today's Huddle that has company stock, before you just take that biggest check you may ever get from the 401k and put it into an IRA, or even if you just leave it in place, consider taking the lump sum option, the net unrealized appreciation. And my team here at Secured Retirement can help you with that decision process. Here's the last option, the fourth option that I came up with, which was converting it. And I say I came up with it. Ed Slott wrote a book on it. He wrote a book on the 4 things to do. It's his first couple chapters. What are the 4 things to do with your largest check? So I guess I'm kind of taking it from him. But you can convert it. Why would I want to do that? Because we're at 40-year lows. I can't think of a better time now with $1.9 trillion of additional stimulus that was passed by the Senate over the weekend. That gets added to all the other stimulus that we've had in place. We're now pushing $30 trillion of debt. In fact, this is the first time since World War II where we are in a situation where our gross domestic product is going to be lower than the deficit. The last time we were here was in World War II. In the 50s, we kind of cut back on a lot of our government spending. I don't know if we're going to do what it took last time after World War II to get us back in shape. My biggest concern is that we are no longer in a situation where taxes are going to likely go up, but they are now going to go up. I'm not the only one saying that. I can say that there aren't a whole lot of things that economists and CPAs and government officials all agree on, but the one thing is that they all agree tax rates are going to probably have to go up. They differ a little bit on who's going to pay for that going up, but I can tell you because of a 4-letter word, math, M-A-T-H, it's going to impact everybody. Anybody listening to this is going to be impacted. So before you just roll that 401k, put it into an IRA, let's look at if we should be looking at Roth conversions on it, taking advantage of 40-year lows, and what have you. Some of you are even in plans right now where you can be doing this while you're still working. That's a great thing. Let us use our team here, Secured Retirement, to show you how much we can do, help you calculate that. Know what the pros and cons are. Anything we do is never going to be a perfect plan. There's never, other trade-offs. So let's focus on what the trade-offs are and make sure we're putting the best plan in place for you. If you're joining us here today on the Market Huddle, I want to make sure that everybody has an opportunity to get a copy of Ed Slott's book. I really do think this is that important. If you're going to retire, if your retirement planning is important to you, read this book. It's a great book. Again, Ed Slott, I consider him a personal mentor. And what we're going to do here is if you schedule your review with one of our team members here by clicking the box there to schedule a call, we're going to make sure we get you a signed copy of this book. Now, for those of you who are currently clients that are already working with us here, so we don't end up having you. You can always schedule a meeting, of course, right? But if you don't really want a meeting, but you just want a copy of Jed's signed book, so you don't have to order it on Amazon. I think that the price on Amazon is $13.99. I have to double check that, but it was around that price, about $13, $15 on Amazon. I'll get you a signed copy of this. You'll have it by Tuesday, Wednesday. You'll be reading right away. So go ahead and email us at info@securedretirements.com. I'm going to try this one more time here and see if it'll create a little hyperlink. And if it doesn't, then, well, then copy and paste it, I guess. No, it didn't do it that time either. So anyways, I don't think it did. Go ahead and email us at info@securedretirements. Make sure that you put in there the subject line, just put down Ed Slott's book or the new Retirement Savings Time Bomb. Here's the book here. I want to thank you again for joining us each week here on the Market Huddle. But this week, a little unadvertised bonus. If you email us, I want to make sure we get you a copy of the book. We should be able to get those in the mail today, depending on where you're at. If you're up in Nisswa, we'll even overnight one so you get it right away, okay, Bob? Anyways, with that said, that's all we have for this morning. Let me double check, make sure nobody has any questions. I don't see any questions here. Again, if you want a copy of the book, here's how you do it. If you're not a client, schedule a 15-minute phone call. We're going to make sure we get you a copy. Just have the conversation with us. Let's start the engagement. If you're already a client, you can either go that route if you've got anything you want to talk about. Maybe you want to review one of these 4 options in your own personal situation. Or if you really just want a copy of the book, I want to thank you for joining us each week. Email us and say, hey, send us a free copy, Joe. Put in the subject line, Ed Slott's book or Slott book, something like that. And then just in the subject saying, hey, we were on the call, and if you can get us a copy, and I'll get that out. With that said, kind of a quicker Market Huddle this week. I hope everybody enjoys some of this weather we're getting here in Minneapolis. Starting to feel a little bit like spring. And in fact, I didn't even bring my jacket this morning. But we'll be back next Monday morning with another Market Huddle. And I hope everybody has a great week. Have a good day.